Okay, time for our next video. We went through in the first segment, the terminology that is associated with gains and losses. Beyond just the right term of realized versus recognized gains and losses, we have to categorize and classify the gain or loss. So how do we do that depends upon the type of asset that's being sold. There's ordinary asset treatment and capital treatment. Ordinary gains and losses is the default classification. The gains are fully taxed as regular income, and then losses are fully deductible. When it comes to capital gains and losses, they have special tax treatment in our code. So we'll look at the capital gains and losses first. So capital assets, by definition, they're going to be anything that's not income producing, including inventory, accounts receivable, and depreciable assets sold in the business. So anything that's sold in the business setting, generally speaking, is going to be an ordinary asset. Anything that's non-business then would be the capital asset. So when you do sell a personal use asset, that by default is a capital asset. Most common capital assets that we see on tax returns would be the buying and selling of stocks that some individual investors do. So we have capital assets. Um, And generally, as long as you see no business purpose for the asset, you should default to the capital treatment. Why capital is important is that the fact that it does have special tax rates. Um, and because it does end up with special tax rates for the underlying assets, we have to calculate netting the gains and losses on different sales during the year. So the netting rules say first look at holding periods of the asset, and to the extent that there are net losses in the capital category, those losses can be applied to the category with the highest tax rate. So we have a slide coming up here, but we'll just kind of put it over here for now. When we say holding period, holding period is one of two options. So it's either long term, which equals greater than a year, or it's short term. So the holding period, we first categorize transactions for that year based on whether or not it was a long-term holding period or a short-term holding period. Um, just a short example there with Ray. He's going to sell the three different stocks this year. Stock one has a short-term capital gain $100. Stock two, short-term capital loss $300. Stock three, short-term, long-term capital gain for $200. So the STs there refer to short-term, the LTs are long-term, and then the CGs and CLs. CG would be a gain, capital gain. CL would be the capital loss. So Ray's net capital gain or loss would end up being here that he's allowed to take his short-term net loss of $200 for capital losses. He can net that against the long-term capital gain. So he actually will end up with zero income from these transactions, but he still has to record them on the tax return and report the three separate sales. Why the netting process is important to get long-term and short-term treatments. Um, Primarily is because of the differing tax rates on our assets. So short-term capital gains apply when the asset's being held less than a year, 1 year or less, I should say. So it could be exactly 1 year. Uh, and it's going to be based on the tax rate of the taxpayer. So whatever your marginal tax rate is, if you include this gain, it'll be taxed at that marginal tax rate. If you hold an asset for greater than a year, so the tax code wanted to incentivize holding on to assets for longer holding periods. Um, then it depends on the type of asset you're selling, and you'll either have a 20% rate based on your tax bracket being in the highest tax brackets, 15% or zero. So is our general rule for most assets. Then if you have a collectible, something that you would label as something you've held uh, uh, with the primary purpose of collecting, you would have to tax it at a flat 28%. And when you have what we call depreciation recapture on certain types of assets, it's taxed at 25%. We don't get into the 25% maximum rate on those depreciable assets. Uh, I would like, if we can get to it in the business topics, we would try to, but I'm not sure that we will. So the ones you really will need to focus on is the fact that the short term are at your tax rate, marginal tax rates. The long term collectibles have their separate rate of 28%. And then the other three, 20%, 15%, and zero, are based upon the marginal tax rate of the taxpayer. So the highest tax brackets would take a 20% rate, the bottom tax brackets would have 0% rate. Why the losses are important. Capital losses for individuals, they can be deducted with a $3,000 max. It doesn't say that you can't use more than $3,000 in a year. It simply means that if you're going to record it as a net loss for the year, the most you can use to offset other sources of income is $3,000. So, and they have indefinite carryover lives. So you'll eventually, hopefully, use up whatever losses you have. For example, if we had something where we had a net capital loss of $30,000. So within the last year or two, a lot of investors were experiencing pretty high declines in their value of their stock portfolios. So a net capital loss for the year 30,000 is probably uh, pretty reasonable. With that $30,000, if that's our only investing, and so our when it comes to capital transactions, the only thing we have is that $30,000. Then what we would see is 3,000 reported in the current year. That 3,000 is subtracted then so that there's 27. Oops, that gets a carry forward treatment. So we use that 30,000. But what it doesn't say, so original fact pattern, we said if you had just net losses of 30,000, you would take 3,000 this year, you'd have 27,000 to use in future years. These net losses, if we ended up with 30,000 of net losses, we go back to this fact pattern, but then we also had 18,000 net capital gain. So if we had net losses for the year of 30, but net gains of 18, we are allowed to use in the current year or any future years, we can use that capital loss to offset that capital gain. So what we would report then for the tax year, we would still show that $3,000 net loss, but then we would have a carry forward of 30 minus the 18 we're using to offset the gain. So we're down to 12, and then minus the other 3,000. So our carry forward of 9,000 in losses. So make sure that makes sense to you, and if not, make sure we talk about it when I give you an opportunity to on Thursday. But the thought is, when you have these net transactions that produce losses, you can use those to offset other capital gains. And then when it comes to actually showing the net number on their tax return, the most you can deduct for a loss is 3,000. If you'd like to see how this works out, and I'll make a note to pull the schedule up for you on Thursday. The Schedule D is where we report these capital transactions, where we actually list out, the schedule essentially does this calculation for you. The schedule limits you to taking $3,000 of losses per year, but then reporting any remaining balances as carry forwards. Okay, so if you wanted to practice this here, if you want to hit pause and think this through, I'll talk through this example without a break here. But this may be a good one to stop on and make sure you get the concept on your own. Colin is in the 35% tax bracket. He has the following transactions. He has a gain on the G stock. He holds, and he only held it for 5 months. He has a loss on GM stock that was held for 10 months. He's going to have a gain on a collectible. He must have been a stamp collector. He held it for 5 years. There's then land he also holds for just investing um, that he's held for a 3-year period. So of these transactions, we created net gains and losses of 1,000, a loss of 3,000, 2,000, and 4,000. The rules say go to holding periods and try to come to a net number within the holding period. So if we look at the holding period here, there's short-term capital gains and short-term capital losses. So we end up with a net loss of $2,000 on the short-term category. That net loss, we're allowed to, now the question is, if we know there's a net loss between the G stock and the GM stock, how do we know which gains do we get to offset and use that loss with? So we have a $2,000 loss sitting there. We know that collectibles are taxed at a higher rate than other capital assets, investment assets. So the collectible being taxed at 28% or a regular investment being taxed at 15,000, we are going to want to offset, and we are allowed to offset with the highest tax rate remaining. So we're allowed to use our net capital loss to offset the stamp collection. What we end up reporting then is a net long-term capital gain of $4,000. That'll be taxed at the maximum 15% rate. So when we net within holding period first, and then we take, if there is a net loss in the short-term category, we're allowed to use that loss in the next highest remaining tax bracket of gains, in this case, the collectibles. Okay, when it comes to calculating basis, we said basis is generally the cost. One area where we get into a little bit of trouble with basis is what we call the bargain purchase. A bargain purchase occurs when we end up allowing, generally an employee, we allow an individual, it can be a shareholder for the corporation as well. We allow this individual to purchase an asset from the business at below fair market cost. I should say below fair market value. So the example here, Sam's going to purchase from his employer for $20,000. The fair market value of the land is 30. Does Sam recognize any income, and what is his basis? Well, his income is going to be the fact that his employer gave him a discount on an asset purchase. This land was not inventory. This wasn't something that the employer normally would have held in the course of business. So this isn't dealing with employee discounts, but this is something that the employer held separately, an asset, and let an employee purchase it for less than they would have sold it at an arm's length transaction to another individual. So the fact that he has the $10,000 discount, that discount becomes income to Sam. So two things happen here. Sam recognizes income for that discount. And then because he recognizes income, he's allowed to take his basis at fair market value. Essentially what he's doing is he's taking his purchase price of the 20,000, and he gets to add to that the 10 of income that he recognizes. So basis ends up at fair market value because income was recognized for the 10,000. Some other basis considerations. You're probably familiar now with the terms LIFO and FIFO for inventory tracking. The same idea hits when we have multiple assets. For example, if you end up with your 400 shares of GE stock and you decide to sell 20 of those shares, how do you know which 20 of the 400 you sold? A lot of times it's not possible to have what we call specific identification. When that happens and you cannot identify which 20 shares of the stock did you sell, the tax rules say you're allowed to use FIFO treatment. So you choose the basis